Hello, everyone. This is Eustace Leon Greaves Jr., your insurance and financial services advisor, coming to you again. Please forgive me. I've got about 3 cups of Cataldo restaurant cappuccino in me. I'm wired up because the possible loss of this mortgage interest deduction has just got me so worried that I actually sat down and created a tax return for a fictional couple, John Q. and Jane Q. Mortgage, who live at 2222 Mockingbird Lane here in Brooklyn, New York. They have 2 children, Cindy and Deshawn, and a daughter and a son, respectively. Their combined income for the year was $135,000. They had taxable refunds last year, back in 2008. This is based on a 2009 tax return. Taxable refunds from their New York State return of 2008 of $1,200. So always remember, if you itemize the year before, you have to account for, and you received a refund, rather, you have to account for that income on your 1040. So long story short, they had an adjusted gross income of $136,200. Now, they paid $11,950 in what we call our state and local income taxes. Here in New York, we pay both. And especially if you live in New York City, you do pay both. So the only thing they could deduct, or itemize rather, on their itemized deduction page or their Schedule A was the $11,000 plus $11,950 of state and local income taxes. Nothing else. This is what the world will look like without that mortgage interest deduction. Now, because they had no mortgage interest deduction to itemize, when all was said and done, after whatever credits they were getting, like the child tax credit and the making work pay credit of $800, which we may not have after the year 2010, we're not going to have it in 2000, we're not going to have it going forward because they're going to kill everything. They owed $3,378 to the federal government. Let's talk about the state. They were getting a state refund, which is really weird in New York State and City. They were getting a state and city refund of $287. Okay, $287. That's without the mortgage interest deduction. Now we're going to take the same John and Jane Q Mortgage, 2222 Mockingbird Land. Oh, should have been Lane, but I put land. Brooklyn, New York. Cindy and Deshawn are still their children. They still have $136,200 in adjusted gross income down there. There's a difference, however. Now, instead of having itemized deductions of only $11,950, they have itemized deductions of $31,950. How, pray tell? Well, let's go to that Schedule A. The $20,000 in mortgage interest that they paid, they can now take that as an itemized deduction. So instead of $11,950 in itemized deductions, they will now qualify for $31,950 in deductions. And again, I didn't take into consideration gifts they may have made by cash or check to church or different charities. I didn't take into consideration any unreimbursed employee expenses, just their state and local taxes, and now the home mortgage interest. Not bad. What does that mean? Well, when we go to page 2 of the W-2, my lord, they have a refund of $1,656. That is a swing of $5,034. So wait, what just happened? All we did was give them the right to continue to take as an itemized deduction their mortgage interest that they're paying every year. Let's take a look at the state. Instead of the refund they got for $200 and change, it's now $811, a $524 swing. That's not bad. So in other words, over $2,100 is now flowing into this household, as opposed to owing $3,000 and change. So this in plain hard numbers, this is what the mortgage interest deduction will mean to a family, again, earning $136,000. Imagine that that family is only earning 75 total, 50, 40, no matter what it is. If they have a house and they're paying a mortgage, they are paying interest. The ability to take that interest as an itemized deduction will only help them. If the government or if these different panels and commissions are looking for ways to save money, well, I tell you what, or to reduce the deficit, let's not reduce the deficit on the back of people who need all of the help they can get. So again, folks, you're talking about the difference between a refund and no refund. How would you feel being told by your tax preparer every year that you owe, or you had to pay an additional $32, $33, $37, $4,000 in federal tax because you couldn't take your mortgage interest deduction anymore? And I don't think it will stop there. I firmly believe that that's the beginning. The next thing they'll go after will be your ability to deduct real estate taxes. It's not going to end here. So again, contact your local legislators and let them know that I don't think this is, and if you feel this way, I'm not going to put words in your mouth. If you feel this way, let them know I don't think this is the way to go in helping our country close that deficit. You want to know how we can close the deficit? How about we get factories back? We stop giving tax breaks to build things in other places and we have them built here. And everybody sit down and say, this is a living wage I can afford. This is a profit I can deal with. Let's build televisions here. Let's build radios here. Let's manufacture things here and get back into the business of exporting the great products that we used to manufacture here rather than importing everything. Yeah. What can I tell you? Sometimes they tell me I'm crazy, but sometimes crazy people make sense. I'm Eustace Leon Greaves, your insurance and financial service advisors. This has been a Greaves Financial segment. And again, look for my new blog, brooklyncovered.com. It's going to be up and running quite soon. Thank you. God bless. And remember, continue to make it a great day. Take care.